Welcome to today's deep dive. I'm your host, and today we are getting into something that, well, honestly, it affects pretty much anyone trying to build a company right now. We're unpacking a massive 2026 report called The Strategic Evolution of Small Business Credit Dynamics.
Right, which is just a very fancy way of saying we've got a giant stack of data on what lenders are actually doing behind closed doors this year.
Exactly. I mean, navigating business funding often feels like you're, I don't know, wandering through a maze blindfolded. So our mission today is simple. We're going to bust the biggest myths out there, show you exactly what underwriters are looking at, and most importantly, give you a concrete roadmap if you're operating with, less than perfect credit.
Yeah, and to give you some hope, right? Because once you understand this new 2026 data-driven ecosystem, you really can take back control of your financial narrative. It's not just a black box anymore.
So true. But to get there, we have to start by shattering probably the single biggest misconception about getting a loan. It's this idea of the LLC firewall.
Oh, the Financial Witness Protection Program?
Yeah. Right. Like you file the paperwork, you get your official employer identification number, your EIN, and you think, okay, I've built a fortress. On one side is me with my personal mortgage, and on the other is my business.
Right, you assume you're totally insulated. Like if the business hits a rough patch, your personal life is perfectly safe.
Huh.
But the data from this report breaks some bad news. For 86% of small firms, personal and business credit are just inextricably linked.
Wait, 86%? That's almost everybody.
It really is. I mean, for nearly 9 out of 10 entrepreneurs, that firewall is an illusion, and lenders pierce right through it using something called a personal guarantee. In 2026, 59% of small businesses are using one.
And signing that basically means you are legally binding your own personal assets to the corporate debt, right?
Exactly. You are the ultimate backstop. Because look, if your business is young, like under 2 or 3 years old, it doesn't have a track record. So underwriters use your personal financial habits as a proxy. They heavily scrutinize your personal payment history, which is 35% of your FICO score, and your credit utilization, which is another 30%.
Okay, wait, let me push back on that for a second. Say, my business is booming. Revenue is doubling every month. But personally, I just put, I don't know, a massive home renovation on my personal credit card and my utilization spikes. Are you saying that personal card balance could actually tank my corporate loan?
It absolutely can. I mean, it happens all the time. To an underwriter, high personal credit utilization signals cash flow stress, even if your business account is totally flush.
Wow. That's incredibly frustrating. It's like a teacher grading a group project based entirely on one student's middle school report card.
That's a great way to put it. And honestly, the industry knew it was a blunt instrument, which is why they created a blended metric. It's called the FICO Small Business Scoring Service, or the SBSS.
Okay, the SBSS, how does that work?
So instead of just looking at your personal FICO, it's a score from 0 to 300 that synthesizes your personal data with the business's commercial data. It merges the individual and the entity into one algorithm to find the true risk.
Okay, so that sounds better. Is everyone using the 0 to 300 score now?
Well, this is where a huge regulatory shift just happened. Up until recently, the SBA, the Small Business Administration, actually mandated that lenders use the SBSS for their 7(a) small loans. But as of March 1st, 2026, they dropped that mandate.
Oh, really? Why?
Because the algorithm was just automatically rejecting viable businesses over, minor personal credit hiccups. So the government removed the rule to give underwriters more human discretion.
That seems like a massive win for the borrower, no?
In theory, yeah. But in practice, traditional banks love efficiency, so they're still voluntarily using it. If you want an auto approval from a major bank today, you generally still need an SBSS score of about 180 to 200 or higher.
So the numbers still run the show. Which brings us to how these scores dictate your survival in the current economy. The report lays out the 2026 macro baseline. The Fed stabilized rates, leaving the effective federal funds rate at 3.64%, and the WSJ prime rate is sitting at 6.75%.
Right, and that's at 6.75% is the floor. That's what banks charge their absolute most secure corporate clients. Everyone else pays a risk premium on top of that.
Right. So let's break down the lending tiers from the report. At the very top, you've got Tier 1, the elite. These are folks with personal scores between 700 and 850.
Yeah, and for them, it's totally a buyer's market. They're getting traditional bank terms, SBA loans, with APRs from 5% to 11%, and they get time, Right. Repayment terms of 5 to 25 years.
which is amazing for growth. But then you drop down to tier 2. The report calls this the resilient middle scores between 600 and 699. They can get funded, but the cost jumps to like 12% to 25% APR on online term loans.
Exactly.
But wait, a 650 isn't even a terrible score. Why the massive leap in cost? Am I totally locked out of prime SBA loans if I'm sitting at a 650?
It's tough. A 680 is usually the functional threshold for an SBA approval. But, and this is a but that March 2026 rule change did something else. It allowed lenders to use the 30-day SOFR as a base rate instead of just the prime rate.
Okay, hold on. The secured overnight funding rate. Why does an overnight bank trading rate help me get a loan?
Because the 30-day SOR is lower, around 3.67%. Banks often borrow at SOFR themselves. By letting them price SBA loans based on SOFR plus a spread, it matches their internal cost of funds better. When their margins are safer, they have the flexibility to take a chance on that 640 or 650 score.
Ah, okay, so it makes the math work for the underwriter. That's fascinating. But what if you fall below that 600 line? Because from what the report says, traditional doors just slam shut. You enter tier 3.
Yeah. Scores from 300 to 599. It is a completely different world down there.
Right, standard APRs basically vanish. You enter the world of revenue-based funding. And the big trap here is something called the factor rate.
Right. Deceptive by design. I mean, traditional interest is charged on a declining balance, right? You make a payment, your principal shrinks, you pay less interest next month.
Right, that's how a normal loan works.
But a factor rate is a fixed, flat fee calculated at the exact moment of funding. It's just a decimal multiplied by your loan amount.
Let's unpack this with some math because it's brutal. Say I borrow $100,000 for holiday inventory at a 1.3 factor rate. I multiply $100K by 1.3, so I owe $130,000. That's a fixed $30,000 fee. If I have 6 months to pay it back, the formula makes that a 60% APR.
Which is already very high.
Extremely high. But say my business does incredibly well. I sell out in 3 months, I have the cash, and I pay the loan off early. What happens?
Well, you still owe that flat $30,000 fee. You don't save any money by paying early.
Exactly. And because I held the money for half the time, my effective APR essentially doubles to 120%. It's like a payday loan that actually punishes you for succeeding.
It does. And if your score is around a 550, you might trigger an MCA, a merchant cash advance. And with an MCA, they don't wait for a monthly check. They do daily cash sweeps from your business bank account.
Wait, daily?
Daily. They might take 10% of your gross daily receipts every single day until that $130K is paid off.
I mean, taking 10% off the top every day would cause a severe liquidity crisis for almost anyone. You wouldn't be able to make payroll.
Which is exactly why businesses end up taking out a second advance just to pay off the first one. It's called stacked debt. And the APRs on stacked MCAs frequently blow past 150%.
That's horrifying. Because Tier 3 is so expensive, you can just see desperate owners frantically applying anywhere for relief. Which leads into a massive minefield. First, you end up destroying whatever score you have left because of hard pulls.
Right. People don't know the difference between a soft pull and a hard pull. A soft pull is just a background check. No impact on your score.
And a hard pull.
That stays on your report for 2 years. If an algorithm sees you have, like, 5 hard pulls in 2 weeks, it flags you for credit-seeking behavior. You look desperate. Your approval odds just flatline.
But the second part of this minefield is even scarier. It's industrialized fraud. This report outlines a $196 billion U.S. small business fraud landscape.
It's massive. And AI is making it worse. We're seeing a 4-stage scam lifecycle. Lead, deceive, bleed, and clean. They buy lists of rejected applicants. That's the lead. Then they deceive by using AI voice cloning to impersonate real bank executives.
Oh, wow. So you get a call from someone who sounds exactly like a VP at Chase.
Exactly. Offering you a lifeline. Then comes the bleed phase. They say, we just need an upfront insurance fee to unlock your funds. You wire it, and then they clean the money through crypto so it's untraceable.
But how can I tell the difference between a high-risk lender and an actual scammer? Because honestly, they both advertise no credit check.
2 massive red flags. First, upfront fees via crypto or wire transfer. Legitimate lenders deduct fees from the loan proceeds. They never ask you to send money out of pocket to unlock capital.
That makes sense. What's the second red flag?
Confessions of judgment or COJs. If that's in the contract, run. It lets a lender freeze your bank accounts without a trial if they think you defaulted. Legitimate no-credit check platforms like Ramp or Brex, they don't use COJs. You do a soft pull and link to your cash balances instead.
Okay, so if we know the traps to avoid, where can a business owner with a score under 600 safely turn for capital? We need some genuine hope here.
There is hope. The 2026 roadmap actually highlights three legitimate lifelines. Lifeline 1 is CDFI's Community Development Financial Institutions.
Those are the nonprofits, right?
Yeah, and they look at character and community impact over FICO scores. They'll do holistic underwriting and offer term loans at like 5.99%.
Wow, that's incredible compared to 150% MCA. But what if I need more money than a local nonprofit can lend?
Then you look at Lifeline 2, the SSBCI 2.0. It's a $10 billion federal program where states guarantee 50%, 80% of bank loans for underbanked founders. So if you default, the state pays the bank back. It completely removes the bank's risk so they can approve your 580 score.
And states like Illinois and Louisiana are even doing direct microloans with this, right? Getting $1K to $100 to very small businesses.
Exactly. And finally, Lifeline 3 is asset-based financing or invoice factoring.
Oh, here's where it gets really interesting. Factoring is basically credit score judo. Like, if my credit is terrible, but I'm doing business with a massive, reliable Fortune 500 company, the lender looks at their credit, not mine. I'm leveraging my customer's good reputation.
That's exactly it. Companies like Action Opportunity Fund or Seed are great for this. Or equipment lenders like ClickLease and National Funding. They'll approve scores down to 520 because the equipment itself acts as collateral.
Right, if you don't pay, they just take the equipment back. So to recap this whole journey, your personal credit is still your gatekeeper. Factor rates are the enemy of cash flow. But a sub 600 score is no longer a death sentence if you know where to look.
And, there's a silver lining on the regulatory front, too. Right now, 19 states, including New York and California, are legally mandating clear APR disclosures for commercial loans. They're finally treating small business owners with the same protection as everyday consumers.
Which is huge. So to everyone listening, you really have to treat your credit profile not as a permanent record of past mistakes, but as a strategic asset you can manage. But I want to leave you all with one final kind of provocative thought that we haven't even touched on yet. We spent this whole deep dive talking about how lenders look at your business credit. But did you know that, unlike your personal credit, your business credit file is actually a public record?
Yeah, a lot of people don't realize that.
Right. Think about that. As you build up your commercial identity and you start getting those prime rates, anyone, your vendors, your potential partners, and yes, even your fiercest competitors can just pay a fee and look right at your company's financial resume. It makes you wonder, what story is your business telling the world right now?